Millions of Aussies invest in the share market, but it's not the only way to put your money to work. Yes, the share market offers potential for high returns, but that also comes with an extra bit of volatility. That's where global private credit comes in, one of the fastest growing asset classes in the world over the past 15 years. Global private credit is a form of non-bank business lending on a global scale, and it is much more diversified than Australian private credit. There are limited global private credit providers in Australia. One option is Term Plus. Term Plus target returns are tied to the RBA cash rate plus a fixed spread. Returns can be paid to your bank account or reinvested for compounding. Head to termplus.com.au for more information and to read the PDS. Remember to always consult a financial advisor to find the best fit for your financial circumstances and goals.
G'day, today's guest is US podcaster and fund manager Meb Faber. Meb is the CEO and Chief Investment Officer of Cambria Investment Management, the firm behind Cambria ETFs, a range of funds built on quantitative investment principles. From the global value and momentum strategies to even a cannabis strategy, Cambria's lineup reflects Meb's data-driven approach to markets. In this episode, we dive into how Meb built his funds management business, exploring the thinking behind his shareholder yield ETFs, and discuss how he balances running an investment firm with hosting the Meb Faber Show, one of the most respected podcasts in the investment world. We also touch on some of Meb's most memorable guests and insights they've shared along the way. So, Meb, tell me your origin story. Where did Meb Faber grow up?
I'm a little bit of a mutt in the U.S. I grew up a little bit. I was born Colorado native, so all my sports allegiances, for the most part, are there. And then grew up a little bit in North Carolina, and then did some stops in college in Virginia, and then out in San Francisco, and then moved down to Los Angeles, which I assumed I would hate. I thought it'd be full of soulless vampires and silicone, and which it is, by the way. But it's pretty great spot down here at the beach in Manhattan Beach. Beautiful little beach town full of flip-flops and surfboards and sand. And here we are 20 years later, ready to call myself a local at this point.
And what are your first memories of investing? When did, do you recall when you first kind of got interested in it?
My father was an aerospace engineer, and he grew up wicked poor, like on a farm in Nebraska, no running water, sort of farm poor. First person in his family to go to college. So thinking about money was a topic that was always front of mind for him, very painful. That going out and spending money was always a challenge for him. And, but talking about, the business of farming was an early introduction where we'd go out to the farm and talk about risk, of, hey, the crop just got hailed, but we buy insurance, and on and on and on. And he was always very interested in just the topic of money and business in general. But I was a child of the 80s and 90s. And if you remember the 80s and 90s, in addition to hairspray and neon and hip hop and everything else, there was also a time of romping, stomping bull market, one of the best ever the past couple hundred years. And so particularly in the United States was a time where the lesson you learned was you buy stocks, you put them away, that's that. And so I definitely have some memories, we even have an old postcard listeners for the younger sort is like a letter it's like an email, but it's on a piece of paper. You can send it in the mail. And it was the cheapest way to send a message, although it was kind of weird because it doesn't go inside of an enclosed letter. So it's like an email that anyone can read that happens to see it.
It's like the original blog post.
There you go. But I was at a camp, probably the age of my son now, but I was talking about, some stocks, said what do you think about McDonald's? And I forget the two other I named. Disney was one, and the other, and it's funny because many years later, I went back and said, what if we just bought these? Like I should just quit my entire career, put all my money in these three stocks and called it a day, because they did amazing. It's definitely followed. I think, as an adult or kind of high school, university age, I remember definitely opening an E-Trade account, which for the youngins is kind of like the Robin Hood of my generation, right? And, in college, this is late 90s, so the peak of the boom. We had professors trading stocks in class, and these are professors that should not be trading stocks in class.
As in you're talking to the class and then then I guess they would have been having to put in phone
be
calls.
like, hey, start your assignment, do your test, and then like run over to his computer and be like, this is like a material science professor. Your organic chemistry professor should not be trading CMGI and pets.com and Lucent Technologies. Yeah.
Very much the equivalent of the Uber driver telling you today what stocks to be buying.
Exactly. And so, look, there's a lot of lessons learned, a lot of memories, and obviously the aftermath. And so I certainly see a lot of rhymes today, and we talk a lot about investor education and how to think about it. We're currently writing a book that's a history of stock markets back to 1600, where really you had the first joint stock companies over in Amsterdam. And there's a lot of good lessons in there, where it's fun to look back and see some similarities, even same dumb mistakes we humans make in 2025 that people were making 50, 100, 200 years ago as well.
Yeah, I think that's really important. I think, we've definitely seen, there's a lot of investors I know in Australia who have come to the market post GFC, and they haven't really seen a major correction or crash, and they don't have that memory. And I know stock market history in Australia, it's something investing into Australians is still a relatively new thing. It's not like ingrained in our DNA. Buying and selling property and flipping houses to each other certainly is, and digging holes in the ground. We're pretty good at that.
Baby, gold's $4,000 an ounce, y'all. I mean, I'll show you also my favorite investing book, Triumph the Optimist. That book, I think the only two countries that had better stock market returns than the U.S. were South Africa and Australia. I'll have to update it. I'm not 100% sure because the U.S. has been on a heater.
The U.S., I think, is maybe just has overtaken, but for a very long time, I don't think a lot of Australians would realize this. Australia was the highest performing stock market globally.
Well, I years ago, there was a conference in Torquay. Did I pronounce that right?
Torquay. Torquay. Yeah. The first one. Torquay.
Yeah, where, very early days of the Australian ETF market, and we were considering launching some funds there. And I said, look, I got enough on my plate in the United States, but hey, I will absolutely, let you fly me over and give a speech. And I think the only 4 people in the audience were the organizers, but, it was an awesome trip. I loved it out there.
It's a beautiful town. Town. Did you go surfing?
I don't think so. Trying to even remember. You guys are kind of sharky over there for me. But
so Torquay, just a little bit down the coast from Torquay, you've got Bells Beach. Very famous, of course, for Breakpoint or Point Break.
Mm-hmm.
So tell me about, how did you end up coming to Australia then to potentially launch some ETFs? Is this when with your business Cambria?
Yeah. So I started this company. It's gonna be 20 years ago next year, which is weird. I don't. It feels like just yesterday. And ETFs. If you were talking about ETFs 20 years ago, people would say ETF, like EFT, like what's an ETF? Everyone knows what an ETF is today, but back then it was still kind of this new thing. And it's very clear why they've become so popular: the transparency, lower cost, tax efficiency, on and on and on. But back then, it wasn't quite as obvious that they were we like to say the ETFs are eating the asset management industry. But back then, it wasn't that obvious. And so, we launched our first fund in 2013. We started managing money pre-GFC, so 2007. Started the company in 2006, 2007. But I started writing, and the writing was a bit of an accident. So I started writing academic papers, and then blogs. This is back, we called it back then. Started blogging, and then mainly because I was lonely. I was a little quant stuck in a broom closet trying to interact with the rest of the world.
How did you become a quant?
In college, I was a biomedical engineering student, but again, it was late 90s, and so everyone was investing in IPOs and trading stocks, and a lot of people forget, but the internet.com boom was also a biotech one. And so, the genome was getting sequenced. There's a lot of excitement about the biotech and genetics and genomics companies. And so that was kind of my wheelhouse. I loved reading about all these companies, and they kind of had the same arc as the internet companies which was they went straight up and then went straight down. And I was going to grad school and also working for a biotech mutual fund. And then the stocks must have gone down, I don't know, 80, 90% or something, whatever they did. And I said, I'm just going to delay finishing grad school for another year or two and try to solve this puzzle of investing that has seemingly stumped me and everyone else in the world. And I'm curious. And that just started the long journey, and the fork in the road went left instead of right. And next thing you know, it became a asset management career. But for me, like many of the young investors, like you learn by doing and making the mistakes and discretionary. And I started to realize all the emotional pitfalls that I had. I had all the biases. I was overconfident. If you gave me risk, I would take as much as you could possibly give me and, blow up my account, like on and on and on. So I said, okay, well, I need to come up with some rules, some guardrails. It's like a diet. I would have been the kid that's eating cake at 2 a.m. and, having pizza for breakfast, and said, okay, well, this isn't working. So let's figure this out on the investing side. And that just started a whole career of, all right, I need to study some history. I need to understand really what my expectations should be, position sizing, building portfolios, all that good stuff. That there's a group. My favorite investing quote of the past few years has been, "Every trade makes you richer or wiser, but never both." And I love that just hits home, because everyone today is on Twitter and they're making 100 times their money and buying Ferraris and trading fart coin and on and on. And how much do you learn from that? Probably very little. But when you lose all your money on your Microsoft 3x covered call ETF and shorting who knows whatever it is, you learn those lessons, and then hopefully don't make them again. And hopefully you make them when you're young and don't have a lot of money, because it's a lot more painful when you're my age and you have kids and a family to support and a business and a lot of people that depend on you. Don't want to make those decisions at this point in life, because it can be kind of a terminal situation that's tough to recover from.
I read that I heard one of your very first papers that you published. You originally titled it "A Simple Approach to Market Timing," but you renamed it to "A Quantitative Approach to Tactical Asset Allocation," and it got a much, much better reception from the market timing. Can you tell us a bit about that paper?
Well, I learned clickbait from an early age. Even in the academic community, it's like, no one's going to read this boring sounding paper, or the one that's a little trigger alert, but you put in a few consultant keywords in there: quantitative, tactical, asset allocation, and that's like the trifecta of catnip for institutional people. But let's be honest, I wrote this paper pre-GFC, and had I written it after GFC, probably no one would have read it, but it certainly worked out amazing, as trend following portfolios do, usually during times of big crisis and long, big drawdowns. But I think it granted me certainly a reputation and an aura of intelligence and foresight and thoughtfulness that I don't think I really deserved. And had I published it 2 years later, everyone would have said the opposite. But it was academic papers. So, like many things in life, so many are written to try to impress, their peers. They're not meant to be readable. They're not meant to be, hey, let's make this something that's actually like kind of practical and useful. And so I do think that part of the paper was written in a way that was digestible. We obviously threw it up online so that anyone could read it, as opposed to having to go dig it out of some journal and pay some obscene fee or go to some library. And that started kind of the whole path. I mean, I don't even know how many papers you've written now, 20, 30, 40, thousands of blog posts. But, there's no better peer review than the internet. So back then, you publish a paper, it'd take 2 years, go through all these committees. Now I just throw it up online and everyone will tell me that I'm an idiot within 15 seconds. It's a great feedback mechanism. And but, it helped to get us, when you're a small, tiny asset manager, it helps. It's the marketing and soapbox, which you help get your ideas out there and get people to listen or not.
Let's go back to Cambria, the asset manager. Who do you serve? Who is Cambria set up to serve? Is it the institutions? Is it direct mum and dad investors? Like, who are you aiming to help?
Well, if you saw my recent video, I've been experimenting with AI listeners, and so we posted a video recently of me giving a presentation to the CalPERS board, but CalPERS, which is the large probably the largest pension fund in the United States, $500 billion, but they kind of just consistently get in their own way. And so we wrote an article called, should CalPERS fire everyone and buy some ETFs? And we kind of demonstrate that most institutions in the United States would probably be better off not having these huge committees and 800-page policy portfolios and hundreds of private equity funds and tons of fees, on and on and on. And they could just say, let's call it a day, buy some ETFs. But so the AI lets me give the speech to a bunch of Lego figures instead. But it's kind of any and everyone. So it's, your $500 billion institution all the way to grandma located in Texas willing to buy 10 shares. And that's the beauty of the ETF is you can look up by the end of the year, we'll have 20 funds, over $3 billion in assets, I think it's 150,000 investors. So we got a little bit of everything, chances are, all over the world. But these funds are meant to be digestible and investable from, anyone. Now, some are more esoteric and a little more niche, like we have a tail risk fund. Grandma's probably not buying that, but we have other funds. It's like an all-in-one asset allocation fund. We got some equity, trend, fixed income, a little bit of everything. But the goal when we launch these strategies is, look, it's the best time ever to be an investor. You can buy a portfolio for essentially zero cost, tax efficient, amazing. But, there's 10,000 choices out there. It's like the world's longest cereal line at the grocery store. It's just like, it makes it almost kind of hard. There's so much choice. But, we're trying to only launch funds that don't exist, which seems kind of crazy when you have so many funds. But we think, anytime we do one, that it's a better idea or cheaper in some way. And so we keep coming up with these great, doesn't mean anybody wants them, but it means that we like them. I put all my money into our own funds. A lot of these fund managers out there, you talk to them, they'll go on TV and they'll say, you got to buy this fund. This is why it's great. This is that and the other. And then nobody ever asks them, say, how much do you own? They say, nothing. I don't own any. Why? That's no, it's crazy. I'm not going to buy this. 2% a year.
So I noticed you're a content machine with the podcast, the blog, etc., your papers, books. Was it intentional to build this content machine behind you as a distribution channel to then launch the ETFs off the back of that?
I would like to say that it was, really intentional and well thought out, deliberate plan. But the reality is when you're a startup, when you're an entrepreneur, you have no revenue, nobody knows about you. You got to find your customers some way. I mean, I even wrote an op-ed in the LA Times. Like if your mom has an investing club with her 4 friends, and she wants someone to come give a talk, like I would have done it. I would have driven 2 hours. Any conference, I was an easy speaker in the early days. It's like the struggling comedian.
Meb, we're sitting here talking. I think you still might be.
Yeah. If you're, yeah, exactly. Some Aussie guy asked me, say, hey, you want to come on the show? No, look, it's just, you hustle when it's a startup. And, part of that was writing is it's cheap. You don't hire a 20-person sales team and you can get the word out there, and it's, gets in a lot of places all over the world. And so then it became fun, and it became a great way to interact with people all over the world and get feedback and ideas. And I think I've gained way more from it than anyone else, because I get to talk to people that, where else are you going to be able to ring someone up and say, hey, you want to spend an hour together? They'd be like, no, are you crazy? Why would, say, well, you can come on the podcast, talk about your book or something. I don't know. So there's been a lot of fun, but yeah, I think part of it was also kind of growing up with the internet too. Now, that having been said, content, if you look at some of the biggest money managers, the ones that manage hundreds of billions in the United States, Fisher Investments, Edelman, they also were built on content. Fisher was through a magazine piece and books, great writer. Edelman through radio, just hustling and doing a radio show every week for who knows how many years. So I think content has always been a great way to, interface with potential investors. And at least for us, it was, the necessary route because we didn't have any money.
Let's stick on your podcast for a second, because I was saying to you before off air, I was flicked through the Meb Faber show podcast, and I was looking for a couple of big names to give people the idea of who comes on your show, and the very first one is Morgan Housel. Like, if there's someone outside of probably Warren Buffett and Peter Lynch that gets quoted more often than not about investing and money, etc., it's probably Morgan Housel. He's a very, very quotable man. If someone was approaching your podcast for the first time, what episodes do you think are an absolute must listen?
I have a soft spot in my heart for the old people. That if someone's,
The people who've
60s,
been there and done that.
Well, part of it is because they lose their filters, they get older, they're usually pretty kind, they've been through the experiences, and usually it's a time that most people who are listening didn't experience. So yes, can I get on someone to come on and talk about like what's happening in the world today? That's easy. But like someone could be like, oh, look, let me tell you about this time and this experience investing in the 1950s, or, hey, I was one of the first trend followers in the 1980s, like like, and I think those are stories that are timeless that I love, and then talking to people, you realize how kind many people always think of Wall Street as this terrible, ferocious, pack full of wolves that are going to be predatory. And that's all true. But there's also a lot of, I think, really wonderful people out there that are thoughtful, and passionate. And so like, even some of the earliest, Ed Thorpe was one of my favorites, who for the listeners who don't know that name, he was the first one to figure out how to beat the casino at blackjack by counting cards, and then published a book on it. Like, he didn't have to do that. You could have just made millions of dollars and never said a word, and then later started what at the time was, and still today, one of the best performing hedge funds of all time, and then published a book on it. Same thing. He's getting up there in age, but is still wicked smart and totally on top of it. And so, guests like that, I think, are close to my heart. And some of the historians that aren't even necessarily market participants, I think are a lot of fun too.
Okay, we'll definitely link to that Ed Thorpe episode in the show notes, and I'll pick your brain about those historians afterwards as well. Meb, let's go back now into the actual asset management side of things and talking about your ETFs. I just want to start with a really broad question here for you. What makes a good investment to you?
There's a lot of things out there that I don't put under the category of investments. Investments to me is things like capital assets, like buying a business. And that could be private, the local restaurant down the street, or it could be public, like Google or NVIDIA or Apple. Obviously is the flip side of bonds, but really being the equity owner is the starting point to me, is like the premier asset, thinking about investing. And then to me, that also means that it's, what's the whole point? It's like a Warren Buffett style, getting to a business that has cash flows and successful and is just a machine about how it's run and thoughtful to investors and isn't built to just enrich management, which plenty of them are, and on and on. And it's a very Buffett mentality. There's things that fit under that banner that may not be quite like stocks, like farmland or REITs. Those are businesses, but just a different type. They're a little more real assets. I'm going to say gold miners just to squeeze that in for my Aussies. And then, but there's other assets and strategies that I think can complement and be variants of that. But to me, that's definitely the starting point.
And so Cambria launched your first ETFs in 2013. Can you walk us through, because if someone jumped on your website, they are quite varied, the different strategies that you have, even from a cannabis ETF through to we'll talk about this one as well, the shareholder yield ETF, so strategies. What are your criteria for actually launching an ETF? When you're sitting there designing one, what is the thought process behind it? Can you maybe take us through from ideation to actually launch?
Yeah. And this is a pretty simple funnel for us. The first one is, hopefully it doesn't exist, or if it does exist, it's something we think we can do much better or much cheaper. And I think those are both lofty goals, because look, we have 20 funds by the end of the year, all of which are cheaper in the category average in the US, and some are the cheapest funds in the category. Second is, it has to be backed by some research. So is it something that I can publish, or that hopefully there's a bunch of academic research or practitioner research already? So it's an idea that you can hopefully show historical results for 10, 50, 100 years. Third, and this is a big criteria that crosses out like 90% of the offerings out there, is it something I want to put my own money into? And so many times I'll look at, I'm like, that's the dumbest idea I've ever seen. Why would anyone do that? Raise $5 billion, what do I know? But, and so, and lastly is like, will anyone actually buy it? Does anyone want it? And that one, sometimes we have ideas that I think are brilliant, but I don't think anyone would actually invest in it. So, and we can walk through an example. So if you look at our very first fund, Shareholder Yield.
So Shareholder Yield was your very first ETF.
Correct. And second book, and most of my books you can download for free online, listeners. But the first book was the Ivy Portfolio. But then, so our first ETF was SYLD, which is Shareholder Yield ETF. And it was based on this book and this concept where, a lot of times you hear people say this time is different, these markets are different, things have changed. But most of the time, like, things haven't really changed. They just haven't studied enough history. But when something structural does change, like, you need to account for it. And so particularly in the United States, and we'll go around the world in a minute, but, companies for 100 plus years, one of the biggest tenets of investing is companies would pay out part of their earnings as dividends. And everyone loves dividends. They love passive income. They love getting a big fat yield. They love getting checks in the mail.
So do Americans love dividends as much as Australians? Because Australians are crazy about them.
You guys are up there. You guys you are like probably number one. And so I'm going to make some enemies here, but stick with me. But really accelerating in the 1990s, there's only 5 ways a company can use cash. If you're CEO, this is your menu. There's no secret items on the menu. You can reinvest in the business, which is what every reporter and analyst spends 95% of the time talking about. The new Apple iPod, Tesla's new car, or new robot, whatever. Number 2 is that they can go merge or acquire another company. Number 3 is they can pay out a dividend to shareholders. 4 is they can buy back stock. And 5 is pay down debt. And that's it. That's the menu. You got nothing, no other choices. And so the goal of the CEO is to pull the levers so that they have the highest return for their various projects. And for some companies, that's doing R&D and doing new products. Some companies who just don't have any ideas left, it's returning it to shareholders, whatever. But for the longest time, dividends have been kind of the steady Eddie concept. And a lot of investors, and not a zero number of professionals, don't understand, to get that historical 10%, I'm just rounding, 10% stock return, you have to reinvest those dividends. You get that dividend check in the mail, you got to reinvest it. Otherwise, you're going to get like 5%. You want to go spend it on cocktails and Torquay, like you don't get the 10%, you get 5, right? So anyway, but the thing is, something changed, and there's a lot of myths around buybacks, but they've been around as long as stock markets have been around, because there's 2 sides of that coin. There's share buybacks and share issuance. And they've always been around. They've never been illegal. That's a great myth. But what happened is starting in the late 1990s, buybacks started outpacing dividends. So of the aggregate amount in the United States that companies paid out through dividends and buybacks, they started buying back more stock than they pay out in dividends. And why is that important? Because a buyback at its very core is just a tax efficient or flexible dividend. If the stock's trading at intrinsic value, it's the same thing. Now, if the stock is cheap, so Berkshire, Warren talks about this more than anybody on the planet. If Berkshire's trading at 1 times book, Warren's going to load up the boat and buy a ton of Berkshire. And he said, this is in his 1980s letter. He's like, if a stock's trading below intrinsic value, there's no better use of cash than the CEO to buy back shares. Because you're getting an arbitrage. You're getting $1 for 80 cents or 50 cents, whatever it may be. And so the dividend doesn't have that component. Dividends you're just paying out, but buyback does capture that. But also, what else does the buyback capture? The buyback captures the flip side, which is share issuance. And so you're looking for net buybacks. So you could have theoretically a company that pays a 4% dividend, but if it's issuing 5% a year in shares to management through stock-based compensation or something else, you got a negative yield and you don't even know it. And so in the academic research, when we wrote our first edition of Shareholder Yield, we said, look, this is the premier factor. It beats every dividend strategy we can come up with: dividend growth, high dividend yield, any value strategy we come up with. We said shareholder yield, which is a combination of cash dividends and stock buybacks, historically was an awesome factor. But again, that's just back testing, like, who everyone can come up with a great back test. Anyway, we launched a fund. 12 years later, we have 5 shareholder yield funds. We have a foreign, we have an emerging, we have a large cap, small cap, probably have some more. But that suite has done a great job. And in the ensuing 10 years, there's been a lot more academic and practitioner research supporting this concept of, if you're an investor, you have to account for stock buybacks and share issuance. And so that's a good example of kind of how we think. And so of the thousands of funds, there's still no other shareholder yield ETFs. Now, maybe everyone's just being nice to me saying, hey, look, Meb's done it. We don't want to encroach on his turf. We like him. He's a nice guy. But usually that's not the product.
Well, yeah, maybe they're thinking about your criteria as well. Can they do it better? Can they do it cheaper? Etc. So maybe they can't.
But also part of it is if you have, let's say you're a $100 billion asset manager and you've been telling everyone who would listen for the past 30 years that dividend growth is the right way to invest. It's going to be hard to all of a sudden wake up one morning and be like, oh, you know what? Actually, we actually like shareholder yield. We don't like dividend growth anymore. People will be like, what? What are you talking about? You got 50 billion in this strategy. What have you been doing? So, I think the narrative and storytelling is so much a part of what we all do, and trying to get away from that is a risk to their business.
You kind of back yourself into a corner a bit. So the shareholder yield, your focus there on these suite of ETFs is total return. It's not the income, etc. It's total return. And can you tell me about, I'm interested in the foreign one. What do you hold predominantly in that foreign shareholder yield ETF?
So all these funds, generally they're targeting 100 stocks and they rebalance once a quarter, and they're looking for companies that have high shareholder yield. So usually that's cash dividends and net stock buybacks. We also run a valuation filter. So we said we want the stocks to be cheap, or said differently, not expensive. We don't want to be buying a company that trades at 200 times revenue that's buying back shares. And we want to make sure they're not doing it with a ton of debt. And so you end up with a very high quality, low valuation portfolio. And on average, the stocks coming into that portfolio have a double-digit shareholder yield. So you dividend folks listening, all right? I know you get all hot and bothered about a 4% yield. Think about 10, all right? But in the U.S., the vast majority of the companies, the shareholder yield is dominated by the buyback component. I mean, the dividend yield on the S&P 500 is 1.16. It's knocking on its all-time low in the late 90s, or I think 2000, of 1.1. But the good news is, in general, foreign markets, largely because they've underperformed the past 15 years relative to the S&P, foreign and emerging on average in aggregate are much cheaper. And the cheap companies within the indices are much cheaper too. Now, those tend to be dominated. It tends to be more of a 50-50 stocks, dividends, buybacks. So the yields you see on those funds will often be, the dividend yield will be 4, 5, 6%, but it's changing. And you see in places like Japan, UK, China, on, where all of a sudden the companies are starting to understand corporate governance a little better and saying, oh, okay, wait a second, we're trading at, 0.2 times book. We should be buying back shares, not sitting on this cash, or not paying it out in dividends. So they're starting to be more thoughtful, and it's different talking about this year versus prior years, because ex-US stocks are finally playing a little catch up this year.
I'm curious about I know we don't have time we're not going to run through every single ETF in your suite, but if you can tell us maybe about one or two more that are sitting there right now that you think are maybe a bit underappreciated out of your suite of ETFs. What are you most maybe excited about as well moving forward in your stable?
So we talk a lot about global markets. A lot of investors, Aussies, I know you're going to be guilty of this too. They have that home country bias. They want to put all their money in their own stock market. And historically, that's a no good, terrible, very bad idea. You can ask someone in Russia, in China, in Brazil, in Argentina, on and on. Was it a good idea to put 100% of your money in your own stock market? They say, no, of course not. Even UK and Japan, right?
It's a hard argument to make, though, in the US for some people.
It's hard currently, but
going
forward and at other points in time, it's been an absolutely easy argument to make. And so our largest fund's a U.S. stock fund, but funds 2, 3, 4 are ex-US. And, I don't want to be one of those people that just gets on here and talks about our funds that are crushing it and doing amazing. But I will profile one fund that it buys the cheapest stock markets in the world by long-term valuation metrics. So we'd call this a deep value fund, and this is global value, GVAL, GVAL. And this fund for a long time was just a stinker. 2014 to, I don't know, 2020, it just lagged the U.S., lagged the U.S., lagged the U.S. Part of that's just the U.S., exceptional story. But, everything tends to have a season when it comes to markets. And this fund, we even wrote a piece being like, is something wrong here? Is this broken? It's called Totally Not Crushing It. And we said, is something wrong, or is it just like, this fund is not having a good period? And we concluded that, yeah, it was the latter. And then, that eventually shifts. What was once in the shade is now in the sun. And I think that strategy of buying the cheapest stock markets, but the bad news is you got to be investing in places like Brazil and Poland and Turkey. And I think that's up 40-something% this year, and so will this ex-US value trade continue? I think so. We have this situation in the United States where U.S. stocks have compounded at 15% per year since 2009. And so that's a 10-bagger plus. If you're in the NASDAQ, it's been a 20-bagger. But that's shouldn't count on that going forward. That's only happened a few times in history. And so if you look at the 10-year PE ratio in the U.S., it's over 40 now, whereas in the rest of the world is half that, half. So, I think the U.S. versus ex-U.S. has historically been a coin flip. So we're definitely positive on ex-U.S. markets and think there's probably some reversion. And if you're going to do U.S. markets, there's certainly opportunity. It's just probably not in these mega caps that everyone and their mom owns, the Mag 7, the Mag 8, the market cap weight, because they're pretty pricey.
Your ETFs are predominantly equal weight, aren't they?
For those equity type of funds, yes.
Is there a reason for that rather than, say, market cap weight?
Oh man, you got another hour. Market cap weight, it is the most liquid and it is the market, but it's a curious way to weight something if you think about it. And no other part of the world do I think we weight something by market cap weight, because it's the market cap weight is just price of the stock times shares outstanding. Like there's no tether to fundamentals. And so the problem with market cap weight is when things go nutty to the upside, you are putting most of your money in the things that have gone nuttiest, and if they keep going up, you're putting more and more and more and more and more. It almost sounds like a Ponzi scheme, right? Like it just sounds crazy. So thinking in terms of valuation, I think almost any methodology is going to be better than market cap weight over time, whether it's valuation weighted, whether it's equal weight, on and on. But there are times when it creams everything else, and it's been one of those times for this past cycle for as long as almost anybody can remember.
I'm curious as well. You've described Cambria as in a podcast I listened to of yours, a trend following momentum shop. Can you explain that?
Well, we're circling back all the way to the beginning of our chat. I think there's two halves to my brain. The half is value, like Warren Buffett, and the other half is trend, and that's more of like a Charles Dow, John Henry, type of trend follower. And trend is everyone I think gets value that tends to resonate with people. They get, hey, I'm going to buy this cheaper than I'm going to buy this house. It's cheaper than it's $1 million house. I'm buying it for 500. Great deal. Like they can get their hands around that. Trend following, I feel like, is a little tougher, despite being in markets for 100 years as well, 150 years, if not more. So, trend to me, they're both totally reasonable methodologies. Trend is one that, like, the biggest problem with buy and hold, and we manage buy and hold funds and ETFs, is that, you just got to sit there. You just got to sit through the drawdowns and hope that one day they end. And historically they have, and it takes time. I think it's a lot more than people expect, but you just kind of rebalance and that's that. But I think, as we've seen with prior crises, it's hard for people. 2009, these type of periods has been a struggle. So I think trend following historically, and we actually have a documentary on trend following on our YouTube channel coming out, if it's not out already. I haven't seen it yet, but it's a little fun, little AI assist on this one. But trend, it is an idea that, to me, to a traditional portfolio of long only stocks, bonds, real assets, is probably the premier complement. Because in periods of like a 08, 09, you're either getting out of these markets or you're going short. So it's really the all-time diversifier. The problem is for so many people is it's hard also to do trend following because you look different. And you look different in periods where it's hard to look different. So if you've just been doing anything other than long only sitting in the S&P or, I don't know, Bitcoin, now gold for the past 10, 15 years, like you look worse. And there's nothing worse than your neighbor making hay when you're not.
Can you explain the concept of trend following then? Like, so a lot of people would think it's just jumping on board the AI trend or the latest, whatever the latest current fad is.
Yeah.
But when you're saying it in that context, though, when you're going short when everyone else is long, that might logically to some people not sound like trend following.
Yeah. So trend, if you look at it, it's an idea, again, goes back a very long time. And we have a bit of a literature review, I believe, in the paper we published 20 years ago. But trend, is this concept where you want to be invested in markets that are going up and out, or even short when they're going down. Sounds noble, sounds simple, right? But obviously it's a lot harder than it sounds. So you come up with some simple rules. Some people call them algorithms. Some people call them a trading system, but whatever you want to call it, rules sounds a little easier, that say, hey, look, here's some objective rules to try to be invested during the meat of that big move, and then try to be out when it's going down. And what you find in markets all around the world throughout history is that they're dominated by fat tails and power laws, meaning all of the returns come from very few of the investments. Now, this is true in stocks. This is true in global assets, where you may have 5% of the stocks that generate all the returns of buy and hold, which is crazy to think about. But so it's like, how can we trade all these assets around the world in a way that gives us exposure, and we can try to invest in the ones that we can own for these long periods, where it's not just a 10% move, but 1,000% move or 10,000% move, whatever it may be. And so there's a long history of trend following, and the most simple one that people use is something called like a 200-day moving average, where you're trying to distill all the noise to a little smoother line. In our paper, we wrote about the 10-month moving average, but really just trying to find the signal in the noise and say, hey, look, if the price is above this, you're long. If it goes below, you're out. Now, the problem with this type of strategy is most investors, they want a high batting average. They're playing baseball, or you're doing something, they want to be right, and they want to be right most of the time. And traditionally, a trend following strategy can often have a batting average that's 50%, so coin flip or less. But ideally, you want the winners to be multiples the size of the losers. So you a lot of small paper cuts, which also people don't like. They don't like having a lot of losers. But in general, trying to avoid these, you're probably not going to miss these little 5, 10% downturns. But trying to avoid the 30, 50, 70, 90%ers, like you end up compounding at a much higher rate if you can just sit out these highly volatile down drawdowns.
I just want to talk about one more of your ETFs. In your emerging markets fund, currently the biggest tech is the biggest sector. What excites you about tech in these emerging market opportunities?
Isn't that weird, right? Most people, you say value, they say, well, you're not investing in Meb, you're a value investor. You're probably avoiding tech. And I think that's largely true in the United States. We don't own a whole lot of tech, though. We owned Apple, I think, from 2013 to 2020 in our strategy. So you can own, but most of the tech stocks in the U.S. are either expensive or they're just spending a ton of money. Now, a lot of them are making a lot of money, but for the most part, they're not distributing it through dividends and buybacks. That's not true abroad. So in emerging markets, you have companies, and part of it is because they're much cheaper, that actually are generating a ton of cash flows and buying back stock or paying back dividends. So it's an interesting, people love to say, hey, because in general, value tends to, it's like a big cloud of bees or starlings or something, but it morphs over time. And so in the US, particularly mid cap and small cap looks more interesting than large cap. That having been said, the sectors can wax and wane over time, where it finds opportunities in some and avoids in others.
Just curious, you actually spoke, going right back to the start, that one of the reasons why you found yourself in Torquay is you were potentially going to launch some of your strategies here in Australia. Have you ever revisited that idea? And if so, which ones do you think would suit the Australian appetite?
Just call them mega yield. Come up with shareholder mega yield. I think there's a balance between being thoughtful and serious, and also, conveying what it is you're doing, and hopefully getting people to ride along. I like all my children. We got 20, almost 20 now. And not all of them are appropriate for everyone. And so, one of the things we learn about our business is that people love to chase performance. They can't help themselves. They want to gravitate towards what's working. So for so long, it's been S&P and Mag 7, and all of a sudden you'll have a year or two where other stuff outperforms, or, and you'll see every 3 or 4 years in markets, people get attracted to whatever the kind of hot topic of the day. It could have been the BRICS back in 2007, Brazil, Russia, India, China. Then it was tactical and tail risk hedging after 08, 09. And before that, you had high yield and dividends and floating rate on, and who knows? So we like to think of our funds as being somewhat timeless. Our allocation fund Trinity is an interesting, approach. But I don't know, maybe we'll launch all of them. I don't know. We'll see. I just want an excuse to come hang out in Australia and go surf and scuba diving and catch some rays and hang out. I've never been to the West Side, Perth, and everywhere else too. So
yeah, you got to go over to Perth and go to Rottnest Island and get a photo with a quokka.
There you go. And do what is the Seven Sisters? Then hop down to Tasmania. I got a lot on my to-do list.
The Three Sisters.
3 sisters. Sorry, I added 4. They've been multiplying.
Tassie's cool. You'll enjoy Tasmania. Right, Meb, we've got a couple of questions that we always ask of first-time guests on the podcast. One that my colleague Owen always asks, and one of my own. Here's Owen's. If you could go back in time and tell younger Meb something about life, business, or investing, what would it be?
Oh, so much. I mean, which can I do per year? Like, I got so many things,
You can take it any way you like.
Such a, like looking back, such a motivated youngster. You definitely would have told him to slow it down, but that's part of the journey. Like, I wouldn't have listened. I would have said, you old man, what are you talking about? This is like,
it's funny that you say, slow it down, because you seem like a pretty chill kind of character.
Yeah, I know. Even, through college, I was an engineer. I didn't study abroad because I said, it's too hard to take some of these classes in different language and on, and trying to work. Just chill out a little bit. I feel like I'm okay there now to learn some lessons, but it's not like you say, wow, man, don't make all these dumb trading mistakes, because I thought that was tuition. That's what you pay to learn and to not make those mistakes. So I like those. I'd probably say, don't do a lot of these dumb ski trips, or you end up with a bunch of sutures and broken things. But I wouldn't have listened to that either. So I don't know. I don't think I would have given any advice, because I don't think I would have listened to it. I was too stubborn as a young guy, and I see it now in my 8-year-old. So I got to figure out a different marketing angle, different behavioral psychology, maybe.
It's the positioning of the message, perhaps.
That and buy Bitcoin. That would be the other one.
All right. Now, the last question, this is one I always ask, is me and you, we're going to lunch. Our out of office is on. We're not going back to the office. Where are we going? What are we having? Can be anywhere in the world.
Yeah, I'm a big sushi fan. Seafood, sitting down by the coast, having a beer, some wine or something. Fun crowd. Toes in the sand. That sounds great to me. But I love adventure. So maybe on a mountaintop after a long hike, or sitting in a refugio and drinking hot chocolate and fondue. Man, I'm getting hungry. I didn't have much lunch today, is the problem. I had a little fudge to get some energy for this. But all those sound good. Anything that involves physical activity and adventure, I'm game for.
Right. I'll take you up on the sushi and beers, and I'll catch you at the end of the hike.
Awesome.
Meb, I really appreciate you taking time out of your day over there in California, and joining us here on the Australian Investors Podcast. And hopefully we can see you living your dream at the Seven Sisters here one day in Australia.
You guys come visit us anytime here in Los Angeles, Manhattan Beach. Go Dodgers. And thanks for inviting me.
No stress. Thank you very much, Meb. We'll catch you soon, man.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.